confirm for me the questions we had done for published in class. So you can be able to mention to me those questions we had done for published. I don't want we repeat again doing them in block. I don't want us to repeat again doing them in block. So which question did we attempt? Angela, confirm. Angela, confirm and let me know there on the chat. The questions for published which we had looked at in class. The questions for published which we had looked at in class. Confirm, confirm, confirm. Daniel, which questions, Evans, which questions had we tackled or published in class? So August 2023 question 5, August 2023 question 5, and which other one? August 2023 question 5, April 2024 question 2, April 2024 question 2, and which other one? Only those two. December 2024 question 3. So December 2024 question 3. December 2024 question 3 and April 2023 question 3. April 2023 question 3. April 2023 question 3. Is there any other? Cyprian, is there any other apart from these ones? December 2024 question 4. December 2024 question 4. It was for published, December 2024 question 4. December 2024 question 4. Any other? December 2024 question 4. So you said August 2023 question 5, April 2024 question 2, December 2024 question 3, April 2023 question 3, December 2024 question 4. There are only those ones. Is there any other? Any other? Or they are the only ones? There is none. So I think that's okay. So I wanted to know those questions so that I don't repeat. I want to repeat them again because I want us to revise there. Yeah, so we can begin. So there are questions which I've been able to share there. So there are questions which I've been able to share there. So there are questions which I've been able to share there. I want us to begin. There are questions from published. So there are questions from published. So we can begin with November 2016. Let's start with November 2016. Question number 2. November 2016, question number 2. This is question number 2. Yes, November 2016, question number 2. It is about peak limited. It is about peak limited. So let me know whether you've been able to open that question. Is the one you're going to start with there. November 2015, question number 2. November 2016, question number 2. November 2016, question number 2. So November 2016, question number 2. November 2016, question number 2. November 2016, question number 2. So I can see you are saying, yes, you are there. Yes, you are there. So we can begin. We can begin. So you are told the following trio balance was extracted from the books of Peak Limited as of 31st of October 2016. So you are given there, in this case, a number of items in the trio balance. So we have land, buildings, plant, purchases, distribution expenses, admin. We have loan interest paid. We have leased plant rental paid. We have, in this case, inventory as of 1st of November 2015. That is the opening stock. We have accounts receivables, we have long-term investment, we have revenue, ordinary share capital, income from investment, we have retained earnings, we have 8% debentures, we have dividend that was actually paid, we have account payables, we have cash in hand, we have deferred tax, we have, in this case, bank overdraft, we have accumulated dip. So in this case, those are buildings and of course what plant. So take note that in this case, for example, for items such as deferred tax, we say that whenever you see there's a deferred tax, there's a deferred tax on the credit side of the trio balance. That is the deferred tax at the start of the year. That is the deferred tax at the start of the year. So for us to be able to know how much was, like in this case, the expense or maybe the income from the deferred tax, we'll have to compute the deferred tax liability by the end of the year. The difference between the two will end up having to help us determine whether there was an increase in the deferred tax or there was a decrease. So that figure you're having to see there for deferred tax in the trio balance, just take note. It is the deferred tax liability at the start. It is on the debit side, it is a deferred tax asset. It is a deferred tax what asset. It is on the credit side, it is a deferred tax what liability. Deferred tax liability. Then you are given additional information. The 8% debentures were issued on 1st of January 2016. Interest is payable 6 months in arrears. So they actually pay interest in 6 months in arrears. There's some interest which was actually paid. I think it is somewhere there. So have you been given some interest which was actually paid? Loan interest paid, it is there, 12. So that means in this case, they were having to settle in this case interest for 6 months. After every 6 months, they settle. So inventory was valued at 259.2 billion by the end of the year. On 1st of November 2015, Peak Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which was payable in advance with effect from 1st of November at the start of the year, was in this case 132 million. The fair value of the plant is actually in this case 552 million, and the implicit interest rate is 10% per annum. So that is what lease is. So that is leases. Do you know how to compute leases? So under leases, you have to in this case determine the right of use of the asset. You have to determine the long-term liability element of the lease. You have to determine the short-term liability element of the lease. You have to determine the interest expense on that lease. Then, of course, in this case, also you have to do what? Compute the depreciation on the right of use of the asset. So that's what you need to be able to take note of in this case, what leases. So that is a lease. We'll end up having to do a number of computations there. So plant is depreciated at the rate of 15% per annum using a reducing balance method. Deep expense is to be included under cost of what sales in the income statement. So land and buildings were revalued on 1st of November 2015 at 600 million and 1050 million respectively. After revaluation, the buildings were estimated to have a useful life of 35 years with nil book value at the end of what? Their useful life. So they changed in this case what? The policy for valuing land and buildings. The corporate tax for the year ended 31st of October was in this case 169.8 million. The deferred tax provision as at the end of the year was increased, was in this case increased to in this case 84.6 what million. So that is the deferred tax liability at the end of the period. So in this case, you're not having to compute, but in this case, you've already actually been given the final figure by the end of the day in terms of what the deferred tax. So you need to get the difference between the two. That 84.6 you will end up having to deduct from in this case what 75. So there was what an increase. So that is in this case what a deferred tax expense. If it's an increase, it is a deferred tax expense. If there was a decrease, it would have actually been what a deferred tax inflow or income. And therefore, in this case, it means we would have actually been able to deduct from that 169.8. But in this case, you'll add, because it was increasing, So the deferred tax liability by the start of the year, it was less, but now by the end of the year, it has increased by some amount. That difference will end up having to add on the income tax expense, in this case, what the corporate tax or the current tax. We'll add on the current tax for us to be able to get what the total income tax expense. So you have to, in this case, take note as to why in this case you treat what deferred tax, in this case in what, in published financial statements. So of so much importance, under published financial statements, you have to remember that in this case we say that the way we prepare what the income statement, it is that we'll have, like in this case, just key expenses having to appear: finance cost, admin expenses, and which other one? Selling and distribution. Finance cost, admin, selling and distribution, and which other one? I think those are the key ones. And cost of sales. Cost of sales will have to appear. So all the other items in terms of expenses, they must actually be able to fall under these categories. So you don't, in this case, end up having to split them. For example, put depreciation separate. No. The examiner will likely end up having to tell you, for example, DIP will likely end up having to go either under cost of sales, it will go under admin expenses, like that. That's very important to remember about what published financial statements. So in the income statements, the categories of expenses will likely basically fall under cost of sales, selling and distribution, admin, and finance cost. Then when you come to, in this case, the statement of financial position, the items of, in this case, property, plant, and equipment will likely end up having to be put, all of them once together. You don't, in this case, recognize land as having to be separate, buildings as having to be separate, equipment as having to be separate, any other property like machinery having to be separate. All of them, in this case, you have to come up with what? A property, plant, and equipment, what? Movement schedule. Then in this case, we'll like be able to, in this case, give you the total figure for PPE, which in this case, you'll be able to present in the statement of financial position. So if you put them separately, you'll get a wrong in the exam. If you put them separately, you'll get a wrong in the exam. If in this case, you go to the income statement and start having to say, for cost of sales, you do opening stock, add, deduct, you'll get a wrong. You have to, in this case, do it as a working separately. Then in this case, just do what? Indicate one figure for cost of sales. Otherwise, you'll get a wrong. You'll get a wrong in the exam. That's not, in this case, how you present what? The published financial statements as per what? The current IAS number 1, that in this case is what is applicable. That is having to be, in this case, be applied in terms of preparing what? The published financial statements. So of so much importance, let us, in this case, do some workings here and see how this mathematics is going to take us, is exactly going to, in this case, do what take us. So in this case, if you look at additional information number 1, you are told the 8% debentures were issued on 1st of January 2016. So these debentures were issued on what? 1st of January 2016. So it means these debentures have actually been in existence for how many months? These debentures have actually been in existence for how many months? Up to the end of the year. Angela, these debentures have been in existence for how many months? Up to the end of the year. It is how many months? 10 months. And therefore, it simply means in this case, if we are to compute the interest on these debentures up to the end of the year, we have to, in this case, do what? A portion. We won't actually take for the entire year. Remember, the 8% is per annum. So the 8% debentures, in this case, that are there, the 8% debentures that are actually there. So we have, in this case, 8% multiplied by 300 multiplied by 10 out of 12. So how much do you end up having to get as the interest expense for the 10 months? How much do you end up having to get as the interest expense for the 10 months? How much do you end up having to get as the interest expense for the 10 months? When you do that, you know where I've gotten this figure. It is there in the statement, in the tree of balance. The 8% debentures are 300. The value is 300 million. And of course, now in this case, you have to indicate our workings. Our workings are actually in millions. Remember, we said we are serious people. We don't deal with the little money. You're dealing with a lot of money, millions. Our figures are actually not in millions. So what are you getting there? You should be getting a figure there. You're getting 20 million. So this one will likely, in this case, be what? Be the finance cost, part of the finance cost. It will likely be part of the finance finance cost. But you have to remember that if you look at the TO balance, because you're having to be told that after every 6 months, they end up having to pay this what? They end up having to pay this interest. They actually end up having to pay what? This interest. Remember, interest for the entire year is actually in this case supposed to be 24. Is 24. Let's assume this 10/12 was not there. It's supposed to be 24. But in this case, they pay what? Semi-annually. They pay semi-annually 12. They pay semi-annually 12. If you look at the TO balance, you can be able to see 12. Are you able to see a payment of 12? Cyprian, are you able to see a payment of 12 on the TO balance? Are you able to see a payment of 12 on the TO balance? Yes, you should be able to see it. You should be able to see. It means in this case, they'll pay the other 12 after. So in between, after 6 months, that is around June 20, this year we are dealing with, June 2022, 2016, they will pay 12. Then after another 12 months, they'll end up having to pay what? 12. That is December, when the year has already come to an end. And of course, you can be able to see that the interest that is supposed to be settled by the end of the year when you are preparing the financials is actually 20. But now they have paid, in this case, what? 12. So in this case, they are paid what? 12. So in this case, they are paid what? 12. So when you minus the 12 here, we'll basically remain with what? 8. How will we treat this 8? How will you treat this 8? How will you treat that 8? Who can be able to tell us? Francisca, how will you treat that 8? So it will be what? It will be a liability. We call it what? Accrued. We call it what? Accrued interest. We call it accrued interest. So this one basically will be what? Accrued interest payable. Accrued interest payable. It will actually be accrued interest payable. And therefore, in this case, it will be able to appear among us, in this case, what? Our items of current liabilities. So our items of current what? Liabilities. So it will be accrued interest payable, the 8, because they only paid what? 12 for. They paid 12 for. So in this case, you are told there, inventory was valued at 259.2 million by the end of the year. That is what the closing inventory. This one will likely come in handy when in this case, we are trying to do what? Identify, or in this case, having to calculate what? The cost of sales. It can actually end up having to help us to calculate what? The cost of sales. We can be able to get what? The cost of sales. Cost of sales. The cost of sales. How do you get the cost of sales? We normally say in this case what? Opening stock plus the purchases minus the closing stock. So you've actually been given what? The closing stock there. You've been given the closing stock there. Can we get the opening stock? Yes, we can be able to get the opening stock. It is in the TO balance. Angela, it is actually in the TO balance. Look at the TO balance. As of 1st of November, the opening stock was 226.8. We add on the purchases. Can you be able to get the purchases? What is the value of the purchases? What is the value of the purchases, Michelle? What is the value of the purchases? You need to participate. You need to participate. Michelle, you need to participate. What is the value of the purchases? The value of the purchases is how much? 469.2. We need in this case to add 469.2. We less what? The closing stock, which you've actually been given there, 259.2. 259.2, and therefore in this case, our cost of sales will come to how much? Our cost of sales will come to how much? You need to do that mathematics. You need to do that mathematics very quickly. So 226.8 plus 269.2 minus 259.2. When you get 436.8. You need to confirm that figure. Two people have said 436.8. So it will come to what? 436.8. You've already been able to get what the cost of sales that will likely end up having to go to, in this case, what? Our statement of income. Because in this case, they want us to prepare the income statement for Peak Limited by the end of the year. So we've already gotten that. Then we go to the next note. On 1st of November 2015, Peak Limited entered into a 5-year lease agreement for an item of land. This item had an estimated useful life of what? 5 years. So that useful life of 5 years in this case will likely end up having to help us to compute what the dip on the list item. So the annual rental, which was payable in advance with the effect from 1st of November 2015, was in this case a value of 132 million. The fair value of the plant is 552 million. and the implicit interest rate is actually 10% per annum. The implicit interest rate is actually 10% per annum. So if you can be able to recall in this case, when you're having to learn about leases, we said that we can have in this case computation of leases in two ways. So we have in this case computation of leases in two ways. We have in this case in arrears and in what? In advance. So this lease of ours, is it in arrears or in advance? Is it where the lease payments are having to be paid in arrears or in advance? If you look at it, they're having to be paid in what? In advance. They're having to be paid in what? In advance. So therefore, in this case, there, we need to get a number of items there. So under leases, this is what we call what? The right of use of the asset, right of. So we can be able to, in this case, indicate there before we write that. This is basically what the list is. What it was what? A list what? List plant. So list plant for the list plant. List plant. So for this particular list plant, in this case, we'll have to, in this case, get the right of use of asset. Right of use of asset. Right of use of assets. On this right of use of asset, we'll have to, in this case, compute what? The depreciation. We'll have to compute the depreciation. The depreciation. Then, in this case, also on this list item of plants, there'll be in this case what? Interest. There'll be interest that is having to be paid. Interest that will likely be paid. Interest paid. Then we'll have in this case what? The non-current liability element on this list item. Then also in this case what? The current liability element. The current liability element of this what? List item of plant. These are the key figures that in this case you must actually be able to get in terms of what? Items or plant or machineries having been in this case done what? List. So this right of use of the asset will actually end up having to appear in PICS Limited what? Statement of financial position as what? Part of the asset. So, but of course, in this case, we'll have to depreciate it because we've been given what? A useful life. Then also in this case, we have to come up with what we call what? An amortization schedule that will be able to help us get these three items. An amortization schedule to be able to help us to get the three items. That is what? The interest on this list, interest having to be paid on this list, then the non-current liability element of this list, then also in this case, what? The current liability what? Element of this what? Lease obligation or the lease liability. The lease liability. So for us to be able to get the right of use of the asset, first of all, in this case, we have to in this case compute what? We have to in this case compute what? The lease liability. We have to in this case compute what? The lease liability. You first of all have to compute what? The lease liability. To get this right of use of the asset, first of all, we have to in this case compute what? The lease liability. The lease liability. The lease liability. How do we get the lease liability? 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 What do we do? What do we do? What do we do to get that lease liability? What do we do to get that lease liability? You take the rental payments multiplied by what? The rental payments multiplied in this case by what? The present value interest factor of what? Of annuity. You take what? The rental payments multiplied by the present value interest factor of what? Of annuity. The present value interest factor of annuity. The present value interest factor of annuity. So our rental payments that in this case you're having to be told are having to be paid, and they're having to be paid in what? In advance. So this item of plant was actually leased for how many years? 5 years. It was in this case leased for how many years? 5 years. And therefore this amount here that was having to be paid, it was in this case 132 million. See, 132 million. Then we multiply by what? The present value interest factor of annuity. So this is what you know from your financial management. It is 1 minus 1 plus R. 1 minus 1 plus R raised to negative N over R. See, over R like this. Over R. So you have to come and actually place this thing here. You have to come and actually place that thing there so that in this case you can be able to to get it, you can actually be able to get it. So in this case, you'll be able to take 1 minus 1 plus, what is the rate of interest? What is the rate of interest we're having to be given there? It is 10. So 0.1, 0.1. It will be raised to what? It will be raised to 4. Very brilliant. You are the most brilliant students I've met this year. It will actually be 4 because in this case, these are what? Lease payments in what? In advance. Huh? So they are already settled. The first 132 they have already paid. We cannot discount an amount that has already been settled. By this point in time, we are calculating this thing at the start of this particular lease. They have already paid this amount. It has not been paid in future. Maybe in this case, when you talk about having to discount, you are basically getting a future amount to a present amount. So this amount already settled, the first installment already settled. We can no longer, in this case, further discount it. We'll only be able to discount the amount that in this case was paid, the other 4 installments which are having to be paid in future. There are 5 installments for 5 years. Already 132 has been received by the start of the lease. What is remaining to be paid in future are 4 installments. And therefore, we only do what? Discount those ones to get what? The value of the lease liability, the present value of the lease what? Liability. And then in this case, we divide by what? 0.1. 0.1. What do you get? There's a figure you're going to get here. There's a figure you're going to get there. There's a figure you're going to get there. You get what? 418. You'll likely end up having to get 418. 400 and what? And 18. So this now in this case, what? The lease liability. This is the lease liability. From this lease liability now, we can be able to compute what? The right of use of what? Of the asset. We can be able to compute what? The right of use of what? Of the asset. To get the right of use of the asset, which is supposed to appear as an asset element in the statement of financial position, we normally take this lease liability, you add on any advance payment. And the advance payment was actually how much? 132. 132. So we'll have to add 132 here. And even in the case, in this case, there was any other direct cost incurred for this lease to, for example, to be effected. Maybe they incurred what? A legal expense. They involved what? A lawyer. So in this case, craft what? The lease would have added that cost here, but we haven't been told. What only was actually paid initially was the initial what? Rental payment. To get the right to use of the asset, what do you do in this case? You take the lease liability that you've been able to compute here, you add on, you actually end up having to add on in this case what? Any advance payment or any initial payment that was actually done to put this particular lease into what? Into effect, or any other, and also in this case what? Any other direct cost at the point of commencement of what? Of the lease. So for in this case of ours, in this case, the right of use of the asset, the right of use of the asset will only basically in this case be equal to the lease liability here, which in this case is actually 418. We add on the initial payment, which was done initially of 132, which we will not discounted. So in this case, this amount will come to what? 550. It will come to 550. Like that. It's like in this case come to what? 550. I can be able to see our friend is having to tell us you've already been given what? The fair value of the lease. They have given us a value of, in this case, what? 552. 552. 500 and what? 52. We've actually been given what? 552. So this is what is actually going to happen in the exam. This is what the examiner will actually end up having to do. So let me just explain something here. The examiner can actually end up having to give you this fair value. But if they don't give you, I've shown you now how to calculate it. So don't go into the exam and actually say, my leader never showed us and now we don't have the fair value. This is how you get the fair value. If the examiner doesn't give you, because what normally happens is normally round off. They round off to the nearest. Then they can give you what? The fair value. But if they haven't given you, remember this computation you're having to do here, because that is the way in this case the examiner might actually end up having to start having to do what? To frustrate you. To get the fair value of the list, you actually do what you've been able to do here. Or the examiner alternative in this case can be able to give you a figure, which in this case he has given us what? 552. But if you haven't been given, for the benefit of those ones who don't know, because you might not revise leases again, for those ones who don't know, this is how you get the fair value of the lease. This is how you get what? The fair value of the lease. So what the examiner will do, they'll actually give you a rounded off what? Figure. They'll give you a rounded off what? Figure. And then in this case, if they have given you this figure, just use this one. But if they haven't given you the figure, you can actually be able to do what? Use this one. So he'll round off to the nearest, then he'll give you what? The fair value of the lease. But if they haven't given you, remember this one, to get the fair value of the lease, you get the rental payments, you multiply by the present value interest factor of what? Of annuity. And of course, these actually basically are so in this case, you do what? You discount the lease payments to the present. Then in this case, you get what? The fair value what? Of the lease. So therefore, in this case, the fair value of this lease is actually what? 550, but the examiner had given you what? 552. So what is going to happen? We'll just end up having to use this what? Figure. But now remember that if they haven't given you the figure, take note. This is how in this case you get what? The fair value what? Of the lease. The fair value of the lease. This is how you get what? The fair value of the lease. He'll give you a rounded off what? Figure like that. So you can be able to use this one now as the right of use of what? Of the asset. But now we have to do what? Compute what? The depreciation. We have to compute in this case what? The depreciation on this what? On this asset. We have to compute the depreciation on this asset, which you've actually been given what? A useful life of 5 years. So in this case, you can be able to continue. You can do, I want to wrap here. Are you through? I want to wrap there. I want to wrap there. I want to wrap there. So we can get now in this case what? Depreciation. So let's get depreciation of these assets. So you take the useful life of these assets. You take the useful life of these assets. We take in this case the fair value. So depreciation, we can be able to compute depreciation on the assets. Depreciation on a leased assets. Leased assets. In this case, you'll be able to take that fair value, which you've actually been given there, 552, you divide by the useful life of 5. What in this case do you get as the depreciation? What do you get as the depreciation? 552 divided by 5. You get 110.4. 110.4. 110.4. So therefore, in this case, it means what you'll be able to present as the right of use of the asset in the statement of financial position, we'll have to remember, we have to take this 552 minus what has been lost in the first year. So 552 minus what has been lost in the first year, because that's what the depreciation. That is what the depreciation on this what? On this asset. The depreciation asset. So then we are supposed in this case to identify the non-current liability element, the current liability element, and of course now in this case what? The interest expense, the interest expense. So for this one to be determined, you'll have to come up in this case with what? An amortization schedule. Of course, the lease was for 5 years, but now we are only interested for the non-current liability element for which year? 2016, end of 2016, October. End of 2016, October. Therefore, you just prepare for how many years? 2. Don't do for all the 5 years. Don't do for all the 5 years. You're just interested in what? 2016. And therefore, you just go up to what? Second year. Up to the second year. Because with the second year, we can be able to know what was the non-current liability element and of course, what the current liability element. And also in this case, just within the first year in that schedule, we can be able to know how much was the interest expense. Don't go up to 5 years. Just do for how many years? 2. Because we are only interested in which year? The first year, 2016. Which of in this case, if you go up to the second year, you would have already been able to get the figures for MCL and CL. And therefore, we can be able to come up with what? An amortization schedule. Amortization schedule. We can be able to come up with an amortization what? Schedule. So in our schedule, we'll have in this case what? The period. We'll have the period. We'll have the period. We can have the period there. Then in this case, we can be able to have the balance. The balance program. Okay, remember, these payments are having to be done in advance. If they're having to be done in advance, immediately after the balance brought down, we make a payment. We make a payment, and therefore here there's what? A payment. There's a payment. Then once we make a payment, we'll have the balance due. We'll have in this case the balance that was actually due after they have made a payment in advance. There's a balance due. Then after the balance due, in this case, we can be able to compute what? The interest. And in this case, compute the interest, which in this case is at 10%. Then we can in this case have what? The balance carried down. The balance carried down. You can have the balance carried down like that. You can have the balance carried down like that. So we have said we'll only do for 2 periods, the first period and the second period. This is basically 2016, end of 2016, October, and of course of 2017, because we'll be able to get our figures for 2016, which is the year we're having to prepare what? The financials. We won't go up to the 5th year. There is no need because the other figures will pick in the 2nd year. So we would have already been able to complete in this case what? Our schedule there. Would have already in this case been able to complete in this case what? Our schedule there. So therefore in this case, the lease liability. So of course you had actually computed the lease liability. The lease liability you've computed, let me explain something here. The lease liability we've computed, the lease liability in this case you've actually computed is having to come to how much? 418. Is 418. The lease liability is 418. By this time, we are having to start the year. That lease liability computed by using, in this case, what? The present value interest factor is having to come to what? 418. Then we've been able to, in this case, add on. We've actually been able to add on the advance payment, which in this case is what? 132. It is giving us, in this case, what? A total right of use or fair value of this asset having to be, in this case, what? 550. But now remember, in this situation, we've been able to say we are going to use what? 552. And therefore, to be able to know how much was outstanding as a lease liability, we deduct here 132. And therefore, it will likely come to, in this case, how much? It is, this is 0, 2, 420. It's 420, not 418. Hope you are seeing what I'm having to do here. Remember, the lease liability we've computed, let's assume you are not given this figure at all. This figure of 552 at all. You would have used this as the lease liability here to start with 418. 418. But technically, in this case, the examiner has given you what? The fair value of the lease. And therefore, to know what was outstanding when we are commencing this lease, you minus, you take 552, which is the total lease, basically in this case, total fair value of the lease. You deduct what was paid in advance. When you are commencing at the start of the period here, this lease, they have already made a payment of 132. So when you deduct in this case, you'll be able to get that what was outstanding, not yet in this case settled, in this case will likely be how much? 420. 420. But let's assume this figure was not there. You would have used this value here. You would have used this value here, which we computed. And that's how you compute it. Then in this case, you place it here. But we've been given in this case what? The fair value, which is 552. And already when we are commencing here, they have already paid 132. Therefore, what is outstanding, not yet paid, is the difference between the two. So therefore, in this case, as we are commencing, the balance brought down in terms of the lease liability is actually the difference. 552 minus 132, which has been settled, which in this case will come to how much? 420. It is 420. 420. Then remember, under in this case, the schedule. Under the schedule, in this case, for advance payment, here you don't put that 132 because it is what you are just having to deduct here. It has already been settled. So it will likely basically this will be what? Be 0. But now in the 2nd year, it will be there, 132. It will be there. The payment is 132. It's just constant now. After the last, the other 4 years, because you have 1st year, 2nd year, 3rd year, 4th year, 5th year. It will be one. This one has already been settled. Don't put it here. So you will start from the 2nd year, 132, 132, 132, 132, up to the very, very what? Final year. So the balance due here, once you made this payment, is actually having to come to what? 420. And therefore, we calculate what? 10% interest on it, which basically in this case comes to how much? 42. So by the end of the year, it is actually having to come to, in this case, how much? 42, 42, 42, 42, like that. Then when you deduct 420 minus 42, how much do you get? It is supposed to be added. So this is the balance due, then you incur interest on it. It means by the end of the year, in this case, we'll basically, in this case, be having a balance carried forward in terms of the lease liability of 462. So this 462 actually comes here. It will likely be 462. Then we deduct the payment of 132, which will come to, in this case, of 330. This 330, 330. We incur 10% interest on it. It will come to 33. 33 like that. Then in this case, we'll have what? 330 plus 33, it will come to 363. 363. Who hasn't in this case understood what you've done there? So if you've been able to understand what you've done there. I can be able to see you are giving me figures there. So hope you've been able to understand what you've been able to do there. What you've been able to do there. Hope you've been able to understand what you've been able to do there. So in this case, the opening lease liability is 420. initially don't put a payment if the payments are in advance. So because the 132 has already been paid, in the first year, don't put it. Then you'll get the difference, the opening balance plus what you paid initially, you deduct, you'll get 420, the interest, 10% of this, 42. Then the total amount outstanding by the end of the period, you take what was due plus the interest accumulated on this amount, 462, you bring it here, you make the payment again, 132. You basically get the difference, what is outstanding when you are basically commencing. By the end of the year, it is 330, but we charge interest on it, 33, which comes to, in this case, what, 363. And therefore, in this case, we want to know the interest, because in this case, our main focus of, in this case, this particular schedule is for us to know the interest. And therefore, the interest for 2016, you can be able to see it. It is here, is an amount of, in this case, what? Interest is actually, in this case, what? 42. So this means this will actually be part of what? Our finance cost. It will be part of our finance costs in the income statement. It will actually be part of our finance cost, in this case, in what? In the income statement. It will actually be part of our finance cost in the income statement. Then in this case, we can be able to get what? The non-current liability element, and of course, what? The current liability element. So for the non-current liability element, you'll actually end up having to get what? You'll take the balance due. You'll take the balance, supposed to be balance due. You'll take the balance due in the second year. You'll take the balance due in the second year. Then the current liability, you'll actually end up having to take, you'll actually, in this case, take the payment that was actually done in the second year. The payment, because this one is payment in advance. You will take the payment in the second year. The payment in the second year. So therefore, in this case, the balance due in the second year is exactly this amount. Exactly that amount. Then the payment in the second year that was actually done is actually this amount. This amount. So therefore, in this case, it means it actually in this case means that the non-current liability element will actually in this case be an amount of 330, and in this case, the current liability element will actually be an amount of 132. So we have to remember, when we'll be coming up with the statement of financial position, this one will actually appear as an non-current liability. Then this one will likely end up having to appear as what? As a current liability. So like that. Then this one is going to be the expense, the interest. So we need in this case to include this one in the finance cost. Remember, we have that other interest. So we'll add on this amount so that in this case we can get what? The cumulative finance cost. The cumulative finance cost for this PIC Limited. The cumulative finance cost for PIC Limited. The cumulative finance cost for PIC Limited. So that's what in this case is likely going to happen there, is actually going to happen there. So we've already been able to get our figures. In this case, we've said what? Right of use of the asset, depreciation, interest expense, the non-current liability element, and the current liability what? Element. So once you have those ones, then you are good in this case to go with what? That particular list. That particular list there. That particular list. You are good in this case to go with what? That particular list. That particular list. So I can be able to see Daniel saying the non-current liability element is the balance carried down in the second year. Is the balance carried down in the second year. So it's supposed to be the balance due. It's supposed to be the balance due. The one in arrears, that other one in arrears is when you take the balance carried down. Is when in this case you take what? The balance carried down. So in this case, it's actually having to be paid in advance. It is actually in this case in advance, you take the balance due. If in this case it happens to be in arrears, you take in this case the balance what? Carried down. The balance carried down. So take note of that. So in this case, if it is in this case in advance, you take the balance due for this what? For this non-current liability element. If in this case it happens to be in arrears, you will take the balance carried down. You will take the balance carried down. So that in this case the difference between the two. Then in this case, for the one having to be paid in advance, for the current liability, in this case, you take what? The payment. You take in this case what? The payment from the second year. You take the payment from the second year. So those in this case will likely end up having to be what? Non-current liabilities and the current what? Liabilities. Once in this case you are coming up with what? The statement of financial position. Statement of financial position. So we can go in this case now to the other note. The other note, which is actually in this case note number 4. Note number 4. So note number 4. So plant is depreciated at the rate of 15% per annum using the reducing balance method. So depreciation expense is to be included under cost of sales in the income statement. So that depreciation, you actually calculate this one. It will likely go to, in this case, what? The cost of sales. It will go in this case to what? To the cost of sales in the income statement. So the plant items that we have there, so we have in this case plant at cost. So that's in this case our working number 4. So the plant depreciation. Plant depreciation that in this case was not listed. The plant depreciation that in this case was actually in this case not listed. Is actually in this case coming to an amount of in this case how much? 936, and they're having to use in this case what? The reducing balance method. So with the reducing balance method, the cost is actually in this case 936. Will actually in this case minus. What was the accumulated? Was there in this case any accumulated? Any accumulated depreciation? In this case, you have for plant, it is down there 156. So 156. Then in this case, we multiply by that depreciation rate, which in this case is actually what? 15%. Exactly 15%. So what do you get? So 936 is the reducing balance. So 936 is the cost. This is now the accumulated, which is the very, very final item in the trio balance. Then we multiply by what? By 15%. We multiply by 15%. You multiply by 15%, you actually get what? 117. You get 117, so it will come to 117. 117, it will come to 117, which in this case, you've already in this case been advised, it will likely go to the cost of sales. It will go in this case to what? To the cost of sales. It will likely go to the cost of sales. It will go to the cost of sales. So that is done with that. Then in this case, you are told what? Land and buildings were revalued on 1st of November. These are the start of the year at 600 million and 1050 million respectively. So these items of land and buildings were revalued. So we have in this case to get what? That revaluation. So you can be able to do it here. Hope you can be able to see here. So working 5. We have land and buildings. So we're in this case revalued. So land and buildings were revalued on 1st of November. This is what at the start of the year. So on 1st of November 2015, which is in this case the start of the year, they ended up having to revalue the land and of course in this case what? The buildings. So we can have land, and of course you have in this case what? Buildings. Land and buildings. So land, the cost is actually in this case what? 400. The cost is 400, and of course it was revalued up. It was revalued up. Land and buildings were revalued in this case 600 million and 1050 respectively. So this one was what? 600 up to 600. Then we have in this case what? Buildings. So buildings, the value was in this case 1200. But now it was revalued up in this case to how much? It was revalued in this case to 1050. But of course, already in this case, which you have to recognize there. So it was 1200 minus 360. So 1200 minus 360. 1200 minus 360. Then it was revalued up in this case to what? To 10. So this one, you likely end up having to get a revaluation of in this case, what? 200. Then this one is 1200 minus 360, you get 840. So 840 up to 1050. What is the difference there? So 1050 minus 840. 1050 minus 840, you get 210 or something. Get 210. You'll get 210. So it was revalued up by 210. So the cost at the start of the year was actually 1200, but already by this particular point in time, these buildings had already lost 360. So it means in this case, the value at the start of the year for the buildings was in this case 840. It was 840. But now from 840, they went up to in this case what? 1050. It means it increased by how much? 210. So this gives you in this case a total revaluation of 410. 410. This one will likely go to what? The revaluation reserve. Then the evaluation reserve that in this case will likely end up having to create. So in this case, when we are coming up with the statement of changes in equity, we have to remember this reserve that has actually been created as a result of what? In this case, this item having to be revalued over and above, having to be revalued over and above, in this case, what? The initial cost. The initial cost. So this one will go to what? Revaluation reserves. Revaluation reserves. It will likely go to the revaluation reserves. Revaluation reserves. But now we have to calculate in this case what? The depreciation on this new revaluation. we have to calculate depreciation on that item. So we can be able to calculate depreciation on that item. Depreciation on that item. We can be able to calculate depreciation on that item. So that is the evaluation. So this evaluation result, it will actually come to, in this case, how much? 410. Then we calculate what? Depreciation. Depreciation on buildings. Depreciation on buildings. So remember, it has been revalued up to 1050. Then at that particular point in time, they're having to revalue. The useful life of these buildings has changed. So after revaluation, the buildings were estimated to have a useful life of 35 years with the nil book value. So in this case, we use that useful life to calculate the depreciation. So it will likely be 1050. 1050 divided by the useful life of 35 years. What do you get as the depreciation? What do you get as the depreciation there? You should be able to get a value there. It is coming to 30. In this case, get what? 30. You'll likely end up having to get, in this case, what? 30. So you come to this case, what? 30. End up having to go to. So let's confirm whether we are actually being told. So we haven't been told. So in this case, the example is actually silent. You in this case take, in this case, what? To the cost of sales. You can be able to take to the cost of sales. You can take to the cost of sales. You will take to the cost of sales this value, in this case, what? Depreciation. This value will be able to take to the cost of sales, that depreciation. Then the last item, the corporate tax, that's in this case working number 6. Working number 6, you are told that the corporate tax for the year ended 31st of October 2016. So this is what? The income tax expense. Income tax expense. The income tax expense. The income tax expense. So you in this case take the current tax. Current tax, which you've actually been given there, is actually in this case 169.8 million. We need to add on, or in this case maybe deduct. It just depends. Add on or deduct the deferred tax. So if this deferred tax happens to be an increase from the start of the year, you likely end up having to add. If it happens to be in this case a decrease, you will less, because it is like in this case what? An income. So you have to in this case look at the difference between what? The start of the year deferred tax liability and the end of the year deferred tax what? Liability. So you're having to be told at this particular point in time, by the end of the year, when you are preparing the financials, the deferred tax in this case was, the deferred tax liability was in this case an amount of 84.6 million. But if you look at the TO balance, there's a deferred tax figure you're having to see there. It is what? 75, which means there was an increase. There was an increase of 9.6. Is it 9.6 or something? There was an increase there of 9.6. Yes, it is 9.6. 9.6. So you can be able to add there. So the income tax expense. The income tax expense. So you'll be able to take 169.8 plus 9.6. Remember, it is what? It is an increase. This is at the end, and this is at the start. Were it the other way around, it had decreased. You would have actually lessened, because it would have like been in this case like an income. So you need to add, in this case, you'll get here 4. This one is 4. So this one is 18. This is 9. So you get 179.4. 179.4 like that. 179.4. 179.4 like that. And of course, this now will be able to appear as our income tax expense in the P&L account. In the profit and loss what account? It will come to 179.4. So I think you've already been able to do all the workings. So now in this case, you can be able to, in this case, very quickly come up with the income statement. You can be able to come up with the income statement. So PIC Limited. So PIC Limited statement of income. PIC Limited statement of income. PIC Limited statement of income. So PIC Limited. We have a PIC Limited income statement. Income statement for the year ended. For the year ended 31st of October 2016. So we can in this case start with what? The cells. Our figures are in shillings of billions. You can start in this case with the cells. So cells don't have any form of adjustment. So just in this case, pick the way they are. The sales revenue. So the sales revenue, or we will say the revenue. So we have been told it is the revenue. The sales revenue, in this case, it is a figure of 1670.4. This one doesn't have any adjustment. Then we have the cost of sales. We have in this case what? The cost of sales. So for the cost of sales, we had calculated that figure. For the cost of sales, we had calculated that figure. And of course, there are just few adjustments having to affect it. Those depreciations, you will see those depreciations we're having to talk about there. So we have in this case what? The cost of sales. It doesn't have so many adjustments. So the cost of sales figure. So reported, we have in this case the reported, the one we calculated. There's one we calculated, then in this case we need to add what? Add on depreciation on plant. Depreciation on plant. Then we can be able to add on depreciation on buildings. Then also we can be able to add on depreciation on leased plant. The plant that has actually been leased. So the reported, the one in this case we computed, we were able to get a figure of 436.8. So it was 436.8. So we'll take 436.8. Then we've calculated that depreciation on the leased plant. It was coming to 110.4. Was it 110.4? 110 on the leased plant. It was 110.4. Then on buildings, we also calculated on buildings. On buildings, it is having to come to 30. It is coming to 30. Then on the plant, there's that plant that was not actually listed. It was coming to 117. 170. So you need to add 9. In this case, you get what? The cost of sales. What do you get at the figure of the total cost of sales? So total cost of sales. This is a figure you'll be able to get. 436.8 plus 117 plus 30 plus 110.4. All those depreciations will likely go to the cost of sales. So the reported is the one we computed in working number 2. But now we need to adjust it further with those other items. So you get a figure of 694.2. 694.2. And also you are saying 694.2. So we come here, we say in this case what? Less the cost of sales, 694.2. We need to be able to less in this case for us to be able to get the gross profit. What do you get as the gross profit? What do you get as the gross profit? There's a figure you'll be able to get for gross profit there. There's a figure you'll be able to get for gross profit there. $694. 976.2. And so you're saying 976.2. So 976.2. 976.2. You need in this case to look at whether we have any other income. Look at the TIO balance. If we have any other income, you always look on the credit side. Always look on the credit side if we have any other income that you can be able to pick there. You have revenue, ordinary share capital, income from investment. So investment income. Investment income. So there's an investment income of 27. An investment income of 27. An investment income of 27. There's no any other income. So those are liabilities, all of them. Those are liabilities, all of them. Then we can in this case go towards the expenses. The expenses. For the expenses, we have admin, which hasn't been adjusted anyway, in any way. We have admin, we have distribution, it has not been adjusted in any way. Distribution, it has not been adjusted. We have in this case what? The finance cost. Remember the finance cost, we said you need to add 2 items. The one we computed on this case on what? On the 8% debentures was 20. The one in this case you calculated in this amortization schedule, it is coming to how much? The one we calculated the amortization schedule is coming to how much? The one in the amortization schedule is coming to how much? 42. So you need to add what? 42 there. 42 like that. And then in this case, it will come to how much? 62. It will come to 62, which in this case we deduct. So for these ones, we haven't adjusted them in any way. You just pick the way they are in the TIO balance. So for the distribution expenses, in this case is how much? It is 60. So you deduct in this case what? 60. For the admin, is actually in this case what? 33. It is 33. So also this one, we haven't adjusted it in any way. So it's just going the way it is there. Just going the way it is there. So with this one, then you can be able to get in this case what we refer to as what? The profit before tax. You can get the profit before tax. You can get the profit before tax. You can get the profit before tax. So with these ones, you can actually be able to get the profit before tax. So profit, you continue here, so you can be able to get the profit before tax. So our shillings are in millions. You can be able to get the profit before tax. When you get here, there's a figure you'll be able to get here. When you take 976.2 minus 27, so this one is 2 point, this is 9, this is 4, 949, 949.2 minus 33, minus 60, minus 62. What is the profit before tax? The profit before tax, you are getting 1,003.2. So 1,003.2. 1,003.2. Or this one you are adding, so you're not deducting. This one is the one you're getting 1,003.2, sorry, 1,003.2. Now minus to get in this case the profit before tax. Minus these ones, 33, 60, and 62. So 1,003.2, that is correct. Then you minus 33, minus 60, minus 62. You get 848.2. So 848.2, like that. 848.2, like that. 848.2, like that. 848.2. Then in this case, you can go towards the income tax, which you've computed, income tax expense. The income tax expense you've computed, it was coming to how much? It was coming to how much? The income tax expense. The income tax expense, it was coming to 180. Was it 180 point something? 180 point? 178. 178? 179.4. It was coming to 179.4. Yes, 179.4. So we deduct, so that in this case you can be able to get what the profits. You can be able to get the part. You can actually end up having to get the part. You can get in this case what the part. And in this case get what the part. And end up having to get the part. So get the difference. This one is 8. This one is 8. This one is 17 minus 9. You get also 8. This one is 6. This one is 6. This one is 6. 668.8. 668.8. 668.8 is the profit after tax. Is in this case what the profit after tax is actually the profit after tax. Is the profit after tax. The profit after tax. The profit after tax is 668.8 is the profit after tax. Is the profit after tax. Of course, you can be able to add. There was that revaluation gain. See that revaluation gain we got. So you can, in this case, once you've gotten this, how you present the income statement. If there's any other income, any other comprehensive income, for example, revaluation gains, you actually put them after the part here. You don't actually put them immediately here. You actually put them after the part here. So we can be able to say in this case there are what other comprehensive incomes. So other comprehensive incomes, other comprehensive incomes. This is what the gain on revaluation. Gain on revaluation. Which still in this case we'll be able to go to the revaluation reserve. It was in this case an amount of 410. So 410.0. Comprehensive income, not the part, the total comprehensive income. Total comprehensive income. The total comprehensive income, you need to add, it will like in this case be 8.87. So 1078.8. So that in this case will be able to give you the total comprehensive income. So we normally in this case, if there are any gains, we call them other comprehensive incomes, which you don't add them immediately like investment income here. So remember this one, we actually put it as the very final one. It's just a gain you've gotten, but ideally it's not like in this case part of what you've been able to generate as profits out of operations. It's not that you've been able to generate as profits out of operations, so you don't actually put it immediately here. You actually in this case put it as what other comprehensive income, which normally in this case come after the part. They'll actually come after the part there. And then we have what gain on revaluation, so which will end up having to put there 410. Remember, this one will likely also take go towards revaluation reserves, which will appear as an equity item. It will appear as an equity item also. It will appear as an equity item. So that's in this case the end of what? That one. That is the end of that. So 1078.8. Then the second part they want us in this case to come up with what? The statement of changes in equity. So the statement of changes in equity. The second part, they want us to come up with a statement of changes in equity. Statement of changes in equity. The statement of changes in equity. For the statement of changes in equity, we are looking at how the equity items are having to change. We are looking at how the equity items are having to change. And therefore, you identify what are the equity items for this PIC Limited. So, PIC Limited, statement of changes in equity. Statement of changes in equity. Statement of changes in equity for the year ended. For the year ended 31st of October 2016. So to identify the equity items that you have, they are normally in this case, in most of the instances, they likely be put together. They likely be put together. And therefore, you can be able to see, we have in this case, ordinary share capital. We have ordinary share capital. Also, we have in this case, what retained earnings. We have retained earnings. You can be able to see it there. Retained earnings, you can be able to see it there. It is an equity item. 8% debentures, is it an equity item? It is not. It is not. There is no any other. But of course, in this case, there is another one which has actually been created. Revaluation reserve. Revaluation reserve has been created as a result of what that revaluation of those what assets. Was there a balance you have actually been able to put there? So these items, our shillings are actually in millions. For all these items, our shillings are actually in millions. For all these items, our shillings are actually what? In millions, like that. Our shillings are actually in this case in what? In millions, like that. Actually in millions, like that. And therefore, we need in this case to start with what? The balance brought down. Balance brought down. You pick the items that you've actually been, the amount you've been given in the TO balance. For this one, it is not there. So automatically that is a dash. But now in this case, for the ordinary share capital, you've actually been given in this case a value of 900. A value of 900. While in this case, for retained earnings, you've actually been given a value of 717. But revaluation reserve was not there. There were not any form of reserves. They have just been created during what? The year. They have just actually been created during what? The year. Then, in this case, we need to look at how these items are having to change. We haven't actually been told anything about what? The ordinary share capital having to change. That there were new shares which were issued. And therefore, that one simply means it won't change. But now, for the retained earnings, we made some profit during the year. So profit for the year. Profit for the year. Profit for the year. Remember, in this case, you don't pick the total comprehensive income. You likely, in this case, end up having to pick what? The part. You likely, in this case, pick what? The part. You'll pick the part. You'll pick the part. The part is how much? The figure you're having there for part. The figure you're having there for part is how much? You'll pick the part. Don't pick the total comprehensive. Because remember that revaluation reserve basically is coming here, that 410. So the part is 668.8. So we'll be able to pick 668.8. Then we go in this case to what? The other changes that we have here. The other changes that we have here. We have in this case that what? Revaluation gain. Revaluation gain. The revaluation gain, we have it. But now this one goes to what? So the reserves there. So it is actually 410. 410. With these retained earnings, always check whether in this case they made any payment of what? Of dividends. Because if they pay dividends, it will likely reduce what? The retained earnings. So therefore, in this case, look at the TO balance and identify whether they actually made any form of interim or just any form of what? Payment of dividend. So dividend paid. Remember, it is dividend done what? Paid. So in this case, you take what? The dividend that was actually paid during the year. It was in this case an amount of 90. If you look at the TO balance, you'll be able to see a figure of 90 that was paid. You normally pay dividends out of what? The retained earnings. And therefore, you'll be able to get in this case now what? There's no any other change that occurred. There's no any other change that occurred. And therefore, in this case, you should be able to get what? The total values of, in this case, what the items of equity in the statement of changes in equity. The total values for this one, the first one, there is no any mathematics there. You just put 900 like that. So for this one, you can do, so this one is 410. So what are you getting for retained earnings? What are you getting for retained earnings? So 717 plus 668.8 minus 90. Minus 90, you get 1295.8. You get 1295.8. 1295.8 will in this case be the value of what the retained earnings. It will be the value of what the retained earnings. So 1295.8, 1295.8. And that in this case the end of what? That particular item, that particular. So for this one, any 4 correct entries you're having to get in this case what all the marks. If you get this. So if you get any of the 4, so any four correct mark. So for any four correct entries, you're getting all the marks. So maybe you can be able to get this, and this, then you miss out on this. You'll still score your full 4 marks. Or maybe in this case, you get this, and this. You fail to, in this case, get this one. You'll still get the 4 marks. So that's what you're having to say. At least you should be able to make what entries. So it means in this case, even if you don't get this one and this one and this one correct, you can easily score 2 marks here. The balance is brought down because these ones you just pick the way they are. These ones, you're having to adjust. For example, you might get this one wrongly. Then it means you'll get a wrong. You might get it wrongly if you don't do the computation in the income statement correctly. You might get it wrongly. And then maybe you might forget you are supposed to put here dividend what paid. You might get it wrongly. You might also forget you are supposed to put reserves here. You might get it what wrongly. But now this one will just be free marks. Let's take the figures the way they are. So if you remember this one, you can be able to easily get what 3 marks like that. So for any 4 correct entries, any correct entry, you are getting a mark there. And if you get 4 of them correct, you get all the marks. You get all the marks there. So you can now in this case go to what? The statement of financial position. Because that is now in this case the very final statement they want us to prepare. Statement of financial position. Statement of financial position. So 𝑃 Limited statement of financial position. But remember, for the statement of financial position, there is one key figure we haven't been able to compute, which is what? The PPE, which is the property, plant, and equipment. But now we can just be able to start. So all the other things will fall into place as we go on. So we can just be able to start. So 𝑃 Limited statement of financial position. Statement of financial position. So as at statement of financial position as at 31st of October 2016. So with this one, you likely start in this case with what? The non-current asset. Automatically you start with the non-current assets. So non-current assets, which in this case, the first one, it is actually what? Property, plant, and equipment. In this case is what? The property, plant, and of course what? Equipment, the property, plant, and equipment. Property, plant, and equipment, or the PPE. Property, plant, and equipment, that is the PPE. Then you can always, in this case, look at whether we have, so we'll compute this one, you can leave it faster. Just leave it first of all. Then you can always look whether we have any other asset apart from PPE. We have land, which is PPE, buildings, PPE, plant, PPE, distribution expenses, admin expenses, loan interest, paid, leased plant, rental, inventory, accounts receivable, long-term investment. You can see there's long-term investment. That is not PPE. Long-term investment. The long-term investment there is actually in this case a figure of 900 or 540, sorry, 540. It is 540, and there's no any other item. So it means we close the chapter there. We'll actually close the chapter there for, in this case, what there? Non-current assets. We'll close the chapter there for non-current. You go to the current assets. Current assets. We'll close the chapter there for the non-current assets. We go to the current assets. So for the current assets, also just look at the debit side. Whether in this case we have any, we have inventory. So inventory is automatic. This one is in the additional information. It is in the additional information 259.2. 259.2. We have accounts receivable, which doesn't have any adjustment. Accounts receivable, you just pick the way it is. Accounts receivable doesn't have any form of adjustment, just pick the way it is, 327.2. So the essence of even having to leave this, you might compute this figure and you get it wrong. But of course, the other figures here, which don't need adjustments, instead of wasting a lot of time concentrating on something that you might get a wrong figure, and the mark will be the same. The marks that they'll be able to give you is that if there is one mark, here it is one mark, here it is one mark, here it is one mark. So you might compute this one and it is wrong. You might, in this case, start computing it. It gives you a headache, confusion. You waste 10 minutes in looking for this figure. Yet, Angela, you could have already in this case been able to pick the low-hanging fruits here. These are just hanging fruits that you can just be able to pluck like this as you go. But this one now, it is not low-hanging. So in fact, in this case, it is not even ripe. It is not even ripe. It is not even ripe. So you might, in this case, get a lot of stress. By the time it ripes, it gets ripened. It ripes this one. So it would have taken 2 or 3 days to ripe, but this one is already ripe. Just pick it very fast, very fast, very fast. Then now, as you are still picking this one is getting ripened now. So you'll be able to just pick it later. So because you might do this computation, then you get around here. It has wasted your 15 minutes or 10 minutes. So you can be able to leave it fast. Do these other ones, but in this case, you can just automatically be able to place there. So we have accounts receivable, we have inventory. Always look at the debit side. Whether in this case, we can be able to have any other item, or in this case, what? A current asset. We have cash in hand. We have cash in hand. We have cash in hand there. You can be able to see cash in hand of 2 shillings, 2 million. So cash in hand. Imagine that cash in hand doesn't have adjustment. And you get the same mark with this one. Doesn't have that 2. But in this case, it is just 2. The 𝐸𝒔𝒑 story mingi here. You 𝐸𝒔𝒑 story mingi, so you can be able to close the chapter there. You can be able to close the chapter there. You can go to the other side, in this case, what? Of the equity and liabilities. Equity and liabilities. Equity and liabilities like that. So we already in this case been able to come up with a statement of changes in equity, and therefore the ordinary share capital was in this case not having to change. It was remaining as what? 900. It was not having to change. It was remaining as 900. Then we have the retained earnings. We have the retained earnings. Then we have in this case what? The revaluation reserve. This one is 410. This one, the figure is what? 1290. 1295.8. Is it 1295.8? 1295.8. It is 1295.8. Should the inventory be 226 inventory? Let's confirm. Inventory should be 259.2. You take the closing. You take the closing. Don't take the one that is in the TIO balance. You take the closing. If you take the one that in this case is exactly the TIO balance, that is the opening. You take the closing. The closing, you always be given the additional information. Don't pick the one that is the TIO balance. That is the opening. Yet we are looking at figures on this data. We are looking at figures on this debt. We are not looking at figures for opening. We are preparing this statement on this data. So you need to get the inventory on this data, the closing balance. The closing balance. So retained earnings, it was coming to, retained earnings was 1295.8. So 1295.8. 1295.8. We don't have any other items. You can go in this case for the non-current liabilities. Non-current liabilities. You can go to the non-current liabilities. Under non-current liabilities, you have the 8% debentures, 8% debentures, which in this case were of a value of 300 million. 8% debentures. We have the deferred tax, deferred tax, which you have actually been given in the additional information. The deferred tax at the end of the period, it was 84.6. 84.6, that's deferred tax, it was 84.6. The lease obligation, the long-term lease obligation, it was a value of 330. Was it 330 or something? Was it 330? It was a value of 330. The one we said in this case, we take the balance due. Was it 330? I think it was 330. 330. So we'll be able to take 330, 330 like that. 330. Then in this case, go to what? We don't have any other non-current liability. We'll go to the current liabilities. You can go to the current liabilities. You can go to the current liabilities. You can go to the current liability. For the current liabilities, we have the current tax. Current tax. Remember, they just provided, they never paid. This current tax, if you look at the additional information, then the corporate tax for the year ended this was estimated. So they just provided for it 169.8. 169.8. 169.8. We have in this case the lease obligation that we computed. Lease obligation, which we took what? The payment. It was in this case 132. We took the payment, 132, that was having to be paid. Then we have what? Accounts payable. We have the lease obligation. Then accounts payable. If you look at the TIO balance, there's an accounts payable. Accounts payable. We have accounts payable. The accounts payable is of an amount of 202.4. 202.4. Accounts payable of an amount of 202.4. Then we also have a bank overdraft. We have a bank overdraft. I can see you're not able to see there. I can see you're not able to see there. So you are not able to see there. So you can put it like that. So you have that accounts payable 202.4. 202.4. 202.4. Then in this case, we have what? A bank overdraft. There's a bank overdraft. Bank overdraft. Bank overdraft. A bank overdraft of an amount of 20.4. It is 20.4. A bank overdraft of an amount of 20.4. A bank overdraft of an amount of 20.4. Then we have the very final item. The very final item you have to put there is the accrued interest. Remember the accrued interest, which in this case we say you take what? 20 minus 12, which in this case comes to what? 8. So that is the very final item. So after this bank overdraft, you write accrued interest. You add there an item of accrued interest, which was 20 minus 12. Remember, in this case, we calculated 20, but they paid 12. So the outstanding is what? 8. Should be able to get there. You should actually be able to get there. You should be able to get there. You should be able to get the item there. You should be able to get the item there. You should be able to get the item there. Then now we can be able to calculate the value of PPE. So hope you've been able to copy all these ones, because now I want to show you how you'll be able to get the value of PPE. Hope you've been able to copy all those ones. I want to show you how you'll be able to get that value of PPE, property, plant, and equipment. That value of property, plant, and equipment. How you'll be able to get the value of property, plant, and equipment. You've already copied it. Yeah, so we can now be able to get the value of PPE. Let's calculate the value of PPE. So I'm going to rub this one. So I'm going to rub this one so that we can be able to calculate the value of their PPE. The value of PPE, then we insert that figure there. If it will balance, okay. If it won't balance, 𝐶𝐿. If it won't balance, 𝐶𝐿. I go to the next question. If it balances, okay. If it won't balance, 𝐶𝐿. I go to the next question. I don't have time. I have only, in this case, what? Few minutes to be able to finish these things. I don't have time. If it will balance, okay. If it won't balance, we move to the next question. So like that. So in this case, land, remember land was revalued. Remember land was revalued. Land was revalued. And so this one was revalued to what? 600. You remember? You remember? Hope you remember it was revalued to 600. Then we have buildings. Buildings. We have buildings. Remember, buildings are also revalued up to an amount of what? 1050. But remember, there was a loss of depreciation on these buildings of an amount of, in this case, what? 30. And then it means we remained with what? 1020. 1020. Then we go to what? Plant. There's that item of plant, which was not listed, the one that was not in this case list. The cost of this item was in this, when you are starting the it is 936. But already in this case, it has an accumulated depreciation of, in this case, 156. Then the one you've calculated for this year, it is actually 117. And therefore, overall, by the end of the year, this item of plant has remained how much? The cost was 936 when you are starting the year. By this time you are starting the year, the net book value, we have to deduct this 156, which was already the accumulated. But we've calculated for the current year coming to 117. Therefore, the net book value of this plant by the end of the year is how much? You get the difference there. You get the difference there. 663. You'll be able to get in this case what? 663. 663. Then we have the leased plant. The leased plant item. The leased plant item, it had a fair value. In this case, it had what? A fair value. It had a fair value for that leased plant item. It had a fair value, in this case, what? Or in this case, we go to what? The fair value of this item having to be 552 or something. So 552. The right of use. The right of use of this item is 552. Is it 552? So the right of use, is it in this case 552? We minus in this case the degree, which is actually 110.4. Every deduct 552 minus 110.4. Every deduct 110.4. So this was the fair value of that leased item of plant, but now we calculated depreciation on it. It was coming to 110.4. So you get the difference so that you can be able to get the net book value. It is coming to 441.6. 441.6. I can see you are giving me that figure, 441.6. So 441.6. Now you need to be able to add to get in this case the value of PPE. The figure we are supposed to place it. Just add them 600 plus 1020 plus 663 plus 441.6 plus 441.6. $27, 24.6. 27, okay, 27, 24.6. So 27, 24.6. So try to add 27, 24.6 plus 540 plus 259.2 plus 327.2 plus 2. What do you get as the total? What do you get as the total there? You get 38.53. Confirm whether in this case you are getting the same figure on that other side. 38.53. Confirm whether it is the same figure. I can see already it is the same. So that is done and dusted. That is done and dusted. Done and dusted. So these things are not going marambas for us. So yes, things are not going marambas for us. Yes. We can now just comfortably move to the next question. Things are not going marambas for us. Yes. you can just comfortably do what? Move to the next question. So things haven't gone marambas for us. Yes. Yes, yes. So everything is okay. Yes. But remember, I've told you, if you do put there, then it doesn't balance. Don't start scratching your head. That it hasn't balanced. So what am I going to do? You go back again, looking at, don't look. If you haven't done the other questions, first of all, do the other questions. Then you can come back and try to look at what was the problem with this what item. What was the problem with this what item? What can I be able to end up having to do in this case to be able to maybe do that what competition. Then also take note that if it happens in the additional information, these are very difficult working, which you're not actually able to comprehend. That shouldn't actually, in this case, stop you from having to draw the income statement or the statement of financial position. Draw it, because I'm having to tell you, like these items you can see, this one you just place them. They don't have adjustment. So of course, even you can be able to tell from the additional information which items are in the trio balance, and I can't see the examiner talking about them in the additional information. Let me go to this structure very fast. Put there, because I know in this case for PPE, it will have its own issues. It will give me a lot of disturbances. When I'm preparing publish, this PPE, I'll always be able to calculate it. So if you see in the additional information, there's an item, which in this case you feel like, this one I'm trying to interpret. So I'm just wishing Mwalimu was here, but he's not here. I was just wishing Mwalimu was here, but he's not here. So I'm not interpreting this thing. That shouldn't actually, in this case, hinder you from you comfortably starting to draw the income statement. Because there are those items that will have zero adjustment. You can be able to, like revenue. Revenue, I can tell you, rarely in this case, it will have what adjustments in published. The cost of sales, it will have. Admin, it can have. Finance cost, it can have. The selling and distribution, it can have. But sometimes, like you can be able to see in this particular question of ours, we haven't had anything having to touch on the two. Admin, and of course, in this case, what? Distribution. There's nothing touching on them. It means they'll just be able to go the way they are. The way they are. So income tax, there the examiner will have to give me a lot of disturbances. So I have to, in this case, interpret properly, in this case, what? The deferred tax. So I have to know, in this case, the components of the income tax will be the current tax. Then in this case, I need to do what? Maybe add or maybe deduct what? The deferred tax. Depending upon, in this case, whether there was actually an increase or a decrease, if I compare with the start of the year, what? Figure. So what you need to do, especially for deferred tax, you need to look at the questions we did previously, because there are usually some differences as why in this case you'll be able to approach how you'll be able to calculate what the income tax expense. So sometimes in this case they can be in this case what we call what? Over or under provision. Over or under provision of what? Of tax. Which can in this case end up having to occur. So you have to in this case take note of that when you're calculating what the income tax expense. Still the same case, nothing should hinder you to go to the statement of financial position. Inventory, zero adjustment, you can be able to see. Accounts receivable, we haven't adjusted anything. Cash at hand, nothing. Cash at hand, nothing. Corporate tax, that corporate tax they have been able to provide in the additional information. The current tax in most of the instances is just very direct. The examiner will be able to tell you in one of the additional information that in this case, the current tax provided for the year was this amount. The current tax provided for the year was this amount. The corporate tax that was supposed to be paid for the year was this amount. He has already given you a mark in the statement of financial position. It will appear under what? The current liabilities. Of course, for deferred tax, it can mix you up. But of course, I know at this particular level of your expertise, you can at least be able to do something about deferred tax. You'll know if in this case it is a liability at the end, or maybe in this case it could actually end up having to be an asset. But now, in most of the instances, the examiner will actually end up having to give you what? A deferred tax liability. So in this case, they haven't given you are supposed to calculate using the temporary differences. Then in this case, you have to determine the temporary differences, then multiply by 30%. 30%. Multiply by 30%. So accounts payable, that other side, rarely in published will have adjustment. Accounts payable rarely will have adjustment. Then you just have to, in this case, be what? Be keen about what? Any other liability that could actually end up having to do what? To arise. For example, in this case, if you have any outstanding liability, then it will go under what? The current liabilities. It will go under the current liabilities. So as I told you in this case, it is just having to be very strategic with this examiner. He shouldn't frustrate you with the additional information. it should in this case make you fear the question with what? Additional information. So it means in this case, even if there's an item of an additional information you cannot be able to interpret because it has given you some challenges, that doesn't hinder you to comfortably start having to do what? Draw the statement of income and start there with the revenue comfortably. You look at the additional information, revenue is not having to be touched on, it goes the way it is. And that is a mark. Remember, I'm having to tell you that in this case, the mark you'll be able to get here is the same with the mark you'll get here. If this one is 2, this one is 2. And how tedious was it to come up with this item? Almost 10 minutes. But this one, I just picked it directly. Within a second, I had placed it here. And I'm getting the same mark. And I'm getting the same mark. I'm getting what? The same mark. So just in this case, how you'll be able to do what? Approaching. How you'll be able to approach what? The questions. So they shouldn't actually, in this case, make you fear that in this case it will be difficult. Actually, I told you that financial reporting, it is an easy paper to pass compared to even what? Financial management. You know, in financial management, you need in this case what? Formulas. But now here, it is all about what? Entries. So in our question, if there are 20 entries, if you can be able to make 12 of them, already you've been able to score 12. 12 of them, entries without any formula, without any thinking, you'll be able to score how many marks? 12 marks. But now in FM, if you have forgotten worker, then it becomes difficult there. But here is all about what? Entries. Is all about what? Entries. So there's that question, which in this case, I want us just to go through it. I just want us to go through it. It is November 2015, but I won't be able to do it. So I was hoping in this case, you can be able to have a revision class tomorrow. You can be able to have a revision class tomorrow. What time do you think is the best time? What time do you think is the best time? Let's get opinions here. Let's get opinions here. What time do you think is the best time? You can see 11 a.m. You can see 11 a.m., 12 p.m. You know, 12 a.m. is midnight. Where was Susan? You want us to not to sleep, and it is a Friday. 12 a.m. So 12 to 2 p.m., 10 a.m., 2 p.m., 2 p.m. Vance likes 2 p.m., 10 a.m., 11 a.m., 11 a.m. Church. Evans is going to church on Saturday. 12 p.m. 12 p.m. 12 p.m. 2 p.m. 2 p.m. I can see most of you are tending towards, in this case, what? Attending towards so much in this case, 11 a.m., 12 p.m., 12 p.m. So in this case, you can have a middle ground. You can be able to have like a middle ground there. So let's do 12:15. So 12:15. You can do 12:15. You can do 12:15 up to around 2. 12:15 up to around 1:45, or maybe this case up to around 2. I think that will be okay. Because at 2 p.m. I'll be having another class. At 2 p.m. I'll be having another class. So it will be very challenging. If I say at 2 p.m. I'll be having another class, I'll be in another class. I'll be having another class. So we can do maybe 12:15. So let's do 12:15. Let's meet at the middle ground there. 12:15 up to around 1:30, or maybe 1. Let's say 1:30 or maybe 1:45. If it extends so much, it will be 1:45. 1:45. So I can see you asking which topic. So we'll still in this case look at published. We look at published still. So we still look at published. We look at that other question which I've shared. November 2015 question number 1. We look at that other question which I've actually shared. November 2015 question number 1. So we still look at published. We still look at in this case what published. So that's what we'll be able to look at. We'll still look at published. Still look at published. The other question I've actually been able to share, which I've been able to share. Yeah, so I think that's it. So that's it. Let's end there for now. Let's end there for now. So have a good night. Enjoy your Friday. See you tomorrow. See you tomorrow. when you'll be looking at that other question.